Cool, 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 cool. So I'm kind of bringing up Facebook on my one screen here, and then on my other screen is us talking. So um, if anyone is here now live, if you'd like to go ahead and submit your question as a comment on Facebook, or if you're in the meeting with us, I don't know if we have anyone in the meeting with us right now, but if you see us and you hear us and you have a question, go ahead and submit it. I do have some things we could talk about and kind of prompt us for some discussion. So we'll stand by for now for a couple seconds, and then Rich, if you have anything else you want to add before we get into it, go ahead and jump in.
Nope, I just, like I said, I don't know what you wanted to talk about. I know some of the things on the top of our mind at JDL has been, on the funding side of things. So I don't know, maybe we can talk about maybe lending, hard money lending, what that's all about, what they're looking for, just for a lot of beginners that are really not sure how that process works. I think would be very helpful for somebody.
Okay. Yeah, for sure. So actually, it's a little bit like chicken scratch on my board there over here. So you can kind of half see it. But I was going through one of our clients on the mentorship side. So we do have a mentorship program, structured program called Flip More Deals. So if you guys want to check out flipmoredeals.com, or if you go to jdlventures.com, I believe there's a section you can click on the top menu that says investors, if I'm not mistaken, and then it says mentorship. We're not your typical mentorship program that you might hear about, or educational program. We are actively in the business every single day. Right now, Douglas J Development is renovating a little over 10 projects, I think 10 or 11 projects in northern New Jersey and central New Jersey, along with one in Florida. And we also wholesale a bunch of properties, 50, 60 properties a year as far as what JDL does. But fundamentally, because we're in the business, to Rich's point about hard money, we understand it from actually being borrowers ourselves. So we get the process, we understand the nuances. It's important for folks to really get a grasp of how money in real estate deals kind of works. Because if you don't have capital, or you don't have a lot of capital, or maybe if you do have a lot of capital, you still want to be able to leverage what you have and figure out how do you do this business without a whole lot of money. So fundamentally, we could definitely talk about that. So if that's something you want to hear about, just go ahead and again make it a little more engaging. Put a comment in if you see this video live about your specific question on hard money. We'll make sure we cover it. But I'm going to give you guys, I guess, a quick lesson on how hard money lenders operate. So is that cool, Rich? Does that cover kind of?
Yeah, exactly. I think that's what a lot of people, especially a lot of beginners, really don't know much about. I get asked that a lot, so that'd be great.
Another thing, I'll just kind of joke around a little bit. So I'm looking at my screen on Facebook, and actually on my Zoom too. It has my name twice, but that's just because Rich uses my Zoom account. So we're not his name.
One of these days, Doug's going to create me my own account, and then I'll have my name.
Got to upgrade Rich to like his own Zoom thing. So there's not two Doug Becks. There's only one Doug Beck. There's actually multiple. I know another guy named Doug Beck, which I met on LinkedIn once, but it's not the point. That's Rich Lanesky. So he helps run the operations at JDL and also Douglas J, and is involved with various facets of what we do. It also helps with some of our clients with mentorship and whatnot. So that being said, let's dive into it. So with hard money is, the term I've heard people say, there's one particular lender that talks about hard money not being so hard and things like that, because it really has like sort of a negative connotation, just the words hard money. What I think people should think about, another way of calling what hard money really does, is essentially it's a bridge loan. A bridge loan is something that takes you from point A to point B. So in real estate, when you're fixing or flipping the house, you're going from purchasing the property to then obviously renovating it, but ultimately adding value to the property, and then ultimately selling the house for a profit, hopefully. So the bridge goes from purchase to sale. And so similarly with the hard money or bridge loan, you're going to go from when you buy until you sell. That's the kind of loan that you need and that you would want if you're going to borrow money. There's obviously different ways you could fund, the project. You could fund it with a home equity line of credit. You could fund it with your own capital. You could fund it with other people's capital. Today is not a discussion about raising money or all the nuances with that. Just be very careful knowing what you're doing and how you're navigating. We're talking specifically about a segment of financing and funding, typically called in real estate investment world called hard money. So again, bridge loan is the kind of term I'm going to use going forward, though, because I think that's more relevant in terms of the process of what it really does. And so with a bridge loan, or otherwise known as a hard money loan, you're going to have leverage, which the term leverage is how much can I borrow, I should say, based on what I'm buying it for, and how much can I borrow based upon what I'm putting into the project. So for example, if let's say you're buying a property for $200,000 and you're putting in $40,000, that's $240, and let's say you're going to sell it for around $350 or something like that. Well, we could calculate those numbers and say, okay, well, if I'm buying for 200, most bridge lenders, hard money lenders are going to lend you no more than 90% of the purchase price because they want you to have what is called skin in the game. Skin in the game just means like you have some capital of your own that's going to be put towards the purchase. And so, these kind of jargon, if you would, it's business jargon, but it's probably more specific to real estate investors for the most part, I would say, the people who throw these terms around. But effectively, when you're talking to a hard money lender, it's important to recognize that, the more leverage you're requesting, typically the higher the rate you're going to pay and or, the better the deal has to be basically, because remember, there's basically two segments of how hard money kind of works. You have the way that they lend, I should say, is based upon loan to cost and then loan to value. Okay. So another way of saying this would be loan to cost is shorthand to LTC. So LTC stands for loan to cost. LTV is loan to value. Well, what's the difference? And actually, it's crazy. I've heard actually people from the lending companies, their own companies, mix these up, which just boggles my mind how someone could be in a position to lend money but doesn't know how to call the thing the right thing. So the cost of a project, right? The cost of a project is defined as basically the purchase and there's hard cost and there's soft cost. The hard cost would be the purchase, the renovation, and anything that's like a sunken cost in terms of the property. Some people, I guess, would throw taxes, for example, on the soft cost, but really taxes are a must that you have to pay. So I would kind of, I'm not sure if that would fall into hard or soft, but bottom line is you'd have soft costs would be more like carry costs of like interest payments or utility expenses or maintenance or that kind of thing. Soft costs could be anything like legal fees, for example, recording fees, title insurance, those kind of things, closing costs. So those are like your soft costs, right? But your hard costs would be your purchase and your renovation. Typically, it's the two most important ones. And so when you talk about cost, loan to cost, it literally means like if I'm buying this property for $200,000 and I'm putting in $40,000 worth of renovations into this project, and assuming that those numbers are accurate, that means that my loan to cost should be calculated off of a total of 240. My cost, the cost that's defined by the hard money lenders, the way that they typically define loan to cost is predominantly the hard costs, meaning like the things that I just explained, the purchase and the renovation. So they don't look at closing costs typically. They don't look at, and I'm just not a one size fits all thing, but I'm just telling you most of the time they don't look at, those softer costs to be considered as far as loan to cost. Some of them do, but most of them don't. Now, what does that mean though? Well, if I'm getting, for example, let's say 80% loan to cost, let's just do the math. So 200,000 plus 40 is 240 times 0.8 is basically 192. So 192, 240 minus 192 leaves me with $48,000. So 48,000 is the amount of money I would have to have if I'm maxing out and with just the hard cost part, without including the soft cost, without including all the other potential expenses you're going to incur. The lender is going to lend you a maximum of $192,000 for something that's going to cost you $240 without even including the soft costs. So that's what 80% loan to cost. Now there's some lenders like pre-COVID that were lending us 90% loan to cost. I would say the industry average is probably between 80 to 85, what I've seen for the typical borrower. Some lenders are obviously more conservative, and depending on your experience and stuff like that, that could vary. But that's loan to cost, just in a summary format. And then we're going to go into loan to value. So loan to value, there's an as is value, and then there's a after repaired value. The as is value is going to be just that. So like, what is the property worth today without doing any renovations? Are you getting it for a discount based on what the market says it's worth today? Or are you just paying retail, or maybe it's not even above retail, which sounds crazy. I'll tell you more about that in a second though. So with the market being the way it is, there are cases where you pay at retail or sometimes above for the as is value. But the fact of the matter is you cannot have a business and survive and be profitable if you don't have a way to add additional value, which is like doing maybe a bigger project, which is some of the stuff that Douglas J is doing, where you're doing like a large scale renovation. But we'll get to that in more detail. For now, let's just talk about the concept of loan to value. And let's define it as, instead of saying loan to value LTV, let's talk about what some people put LT of ARV, or what do they put? They put LTV of ARV is another way people describe it. I just call it LT ARV, which LT after repaired value, loan to after repaired value. That's the way I think grammatically correct. Call me crazy, but I think that's the way it would sound if you were to say the after repaired value and the loan to that value is LT ARV. Okay.
Sounds nice. I like it.
Yeah. Right. You like that? So LT ARV, you're looking at typically most lenders that we do business with, and that I think the general market would agree with this, will lend at a maximum of right now in this current world, 2020, a 70% loan to after repaired value is typically the max you're going to see on a hard money loan. So let's go through the numbers though. So remember I said before, we're buying this property for 200,000. We'll say we're putting in $40,000 worth of work, which by the way is not a lot of work. We'll get to that in a little bit. And then we're going to sell it for hopefully 350 when it's all done, which sounds like a great deal, and it probably is a decent deal. That's $110,000 gross profit. We're going to go through some terms today because I think it's important for the real estate investors of the world and the people that are attempting to be real estate investors that want to grow their business to understand that they've got to use the right terms in order to be effective in the business. And it frustrates me when I see people use the wrong terms because I take it serious and I consider ourselves to be professionals. So when you talk about profit, there's gross profit, which is basically the amount of money that we see on a accounting sheet somewhere before I take into account other expenses. So for example, it doesn't include probably the soft costs, which is what we would call them, where like you have the carry cost, the closing cost, the interest payments, et cetera. That gross profit is only important as to say a directional idea of what the profitability of the project is. We're not talking about like really getting to the nitty gritty of what I'm going to walk away with at the deal. So the way I get to net profit is I got to consider net profit is the equivalent of taking that gross profit and subtracting out all the other soft costs that we didn't include. However, when we're talking about this deal, let's just say we're buying it for 200, we're putting in 40. We're not going to talk about the soft costs just yet. We're going to get to that in a little bit. But the 350, we said we're going to get a maximum of what, 70%. So 350 times 0.7 is my 245. So 245,000 is the most based upon the loan to value of after repaired value, LTV of ARV or LTARV, that I would be able to borrow on the whole project, assuming that it's really worth 350, which is another big assumption, and assuming that the lender is giving me 70% of that loan to value of ARV. So that's a different number than the 192. Remember, the 192 is a loan to cost. So which one matters? Well, they both kind of matter because the lender's not going to typically, hard money lenders, bridge lenders will not typically lend you more than you're buying the property for. They're not, like, in other words, they're not going to lend you on the purchase portion more than what the property is being purchased for. So if I'm buying it for 200, they're not going to give me 205, for example. So because like the 245 would include my 40K of renovation expense. So if I take away the 40K, I got 245 minus 40K, that's 205. 205 is more than 200, which is what I'm buying it for. But I'm not going to probably get a loan at 100%, 100 and whatever percent from the hard money lender for the purchase price. This doesn't make sense. So that's where the LTC comes into play. And that's also where they start telling you what the maximum leverage, can't remember that current term, leverage, will happen as far as the purchase price and the rehab. So another element, if you have if you drew this on a sheet, right? If you drew LTC, LTARV or LTV of ARV, and then you have a third column that called leverage on purchase and leverage on renovation, those three elements have a lot to do with how a hard money lender will lend you money, because fundamentally they're going to take into consideration the maximum amounts, but then they'll look at variations, like how that all kind of meshes together. So what do I mean? Well, a lot of times a newer borrower, which I know the audience here on Facebook and other places this might go, generally might be, a newer borrower. So if you're a newer borrower, it's okay. Like, congratulations, you've decided to go into business and you're looking to do projects. There's a lot of things that you don't know yet that you're going to find out. Hopefully you can learn a lot from listening to our conversations like this and talking with us further. But the fact of the matter is, it's very dangerous to walk into the business thinking that you can borrow all this money and not have any idea what you're doing, because that's going to put you in a very bad situation. And so what you need to do is you need to understand that because the lenders know that as well, they're not going to give you as much leverage typically on that first deal that you would get if you were done 50 renovations or whatever, like we've done at Douglas J Development in the past handful of years. So you could work towards that, but the first one's probably going to be like a 70 to 80% of leverage on the purchase price. So what does that mean? Well, if I'm buying it for 200,000 and I multiply it by, let's say 80%, that means they're going to give me a maximum, no matter what else the other stuff says, of 160, okay, of a loan for the purchase. So that means I literally have to have 20% down, just like a mortgage. You'd hear, people, FHA mortgages and some conventionals, you can put down like 3%, 4%. But generally speaking, conventional has been known to be like, 10, 20% down is what people think of it as. So not much different here. 20% down, they'll be willing to typically give you, even as a newer borrower, and there's a reason why I'll talk about, 100% of your renovation expense. So they're going to give you that 40K, but they quote unquote give it to you. We'll talk about that in a second. Plus 40K is 200,000. So my total loan is 200, but check it out. At the closing, I can't access the full 200. I can only access the portion that's for the purpose of purchasing the property, which is 160. And the other 40, remember, I got to bring for the purchase. And then the second 40 is for the renovation, which I can't touch until a certain thing happens, which we'll talk about. So anyway, what does that mean? Well, my total loan amount in that example is 200. So far I got 192 for loan to cost. I got 205 for loan to value, I think, or 240 we said, right? 245.
Mhm.
So we got 192, 245, and 200. Those are three different numbers, right? So now what happens? Well, typically they'll look at the combination of those and say, okay, well, where does that work? So let's say for example, they say 200,000. 200,000 divided by the 350. If they gave me a $200,000 loan, and remember, they're not going to give me more than the 80%. So that's kind of what trumps everything else. Like the purchase price leverage is the most they're going to give me, no matter what the other stuff comes out to be. So they're not going to give me 100% on purchase unless I'm really have a great deal and they're really being lenient, which they're not being right now with the COVID still kind of being impacting the world of financial world and otherwise. So usually you're going to max out at that, whatever that leverage point is, plus your renovation being 100%. So that basically means that without even looking at the other numbers, even if the other ones are more or less, the most I can get really is that 200K. Okay. So remember, that's because I took the 80% of the purchase and the 40K of the renovation expense. I'm going to kind of pause there. I see there's a Q&A that came up. I see we have some participants, and I'm also seeing that Rich might have a question or additional. And
just one thing I wanted to add to that really quick before you get into that is that when you do run your numbers and you're looking for your ARV, when you bring it to a lender, just know that they are going to do an appraisal themselves. So if your numbers do not jive with them, the appraisal will trump everything. So just make sure you do your numbers correctly.
Yep, exactly. So there's some good dialogue, by the way, happening on Q&A. So I'm going to get to that question. I'm not sure who submitted that. If you guys want to continue to ask your questions on the Q&A, that's great that you're putting them there. I also want to encourage anyone who's on Facebook watching this to basically plug your question into the comments. And also, if you don't know how to access the actual meeting, if you would, the portion that's inside of Zoom right now, definitely reach out to us. You can send a message to rich@jdlventures.com and also doug@jdlventures.com, and we'll get you access to the next one that we have. Make sure, if you're not already on our list, if you're looking to get more information about, information like we're talking about today with hard money, you're looking at getting a knowledge or experience or resources, definitely check out jdlventures.com. Go ahead and sign up for our wholesale deal list. We don't just wholesale deals. We have a lot of other stuff that we offer, and we're going to be talking about that more coming into the new year. So stay tuned for that. We're going to be revamping our websites and also really promoting out the value we bring to the table for both newer investors, aspiring investors that aren't even started yet, and also newer investors, as well as even seasoned vets that are looking to scale up, because we have a lot of access to resources, including capital sources, including construction management, including deal sources that frankly, are valuable to anybody, no matter what part of the spectrum you're in. So stay tuned for that. And if you have any questions about that, please also include that in the Q&A or the comments. Rich, I think it's important to talk about what you said there. So just do me a favor, throw that into the chat box or the Q&A, just so we don't forget it. If you could, just whatever you just mentioned a second ago. The wavelength I'm on right now is still about that leverage concept. So remember, 80% is for newer borrowers. You might get 90% as you get more experienced. And let's just say, for example, if that was the case here, so 200K times the 0.9 is going to be 180. So it just gives me another 20,000 to what I can use to close. I can finance that 40K additional as long as what? Well, as long as my loan to value and my loan to cost still kind of map out to where they should be. So depending on the lender, they won't let you exceed loan to cost or loan to value of ARV. I've seen lenders go above their typical loan to cost so long as the LTV was still strong. So what do I mean by that? If my loan to cost, let's say, goes up to 90%, my total loan to cost, right? But my loan to value is, let's say, 60%. Well, that might work for a lender because they feel like you're going to build a lot of value. So you deserve to get some more, access to capital, if you would, on the front end. And still there's the construction portion, which I think is worth bridging into this. No pun intended. There's the bridge loan, right? But then the bridge to the construction is the fact that there's an escrow. The word escrow is very important. Escrow basically means that you're going to have another account set up that's basically like a savings account. It's a special kind of savings account that's going to allow you to access the money under certain conditions and have the money be used only for certain reasons. So if you don't know by now, I'm also a partner in a title insurance company called Investors First Title. And there's an escrow account that's managed by my partner, Ken McCarthy, who's a title producer for the past almost 30 years, and he's very seasoned. He knows what he's doing. He's been in this business for longer, almost as long as I've been alive. Not to knock Ken. I love Ken. He's like a brother to me. But you know, he's definitely been doing this for quite a while. But the fact of the matter is, escrow accounts are no joke. Like, escrow accounts are very sensitive. You have to be very careful. There's certain regulations. They're like a mini bank account, like a bank's, you know, a bank, basically a mini bank, essentially, in terms of the regulations that apply to those. But point is, when you have a construction escrow, the same thing applies, where the hard money lender sets that up with a third party custodian or administrator of that escrow account. And what has to happen is, usually when you start the project, you usually have to seed the first payment to the contractor. What do I mean by that? Seeding the contractor's first payment means paying them the first payment. So on that $40,000 renovation project, right, and you're getting kind of a lesson on deal flow and deal analysis here a little bit, and also operations, not just hard money and bridge loans. You have to typically give somewhere between, let's say, 10 to 30%. 10 is like very low, but 30% is probably more like it for someone that is, you know, doesn't have a relationship with the contractor. Sometimes you can do it without giving any money, depending on what phase of the project. But at some point, you're gonna have to give a deposit for something that you haven't received funds for from your lender on. So in other words, you might be able to get the contractor to start doing the demo for free, because there's no cost besides their labor. There's no material cost. But at some point, when they start buying like lumber, or they start buying electrical wiring and boxes and circuits and all kinds of stuff, they're buying outlets, and they're buying switches, and they're buying pipes for plumbing, and they're buying this and that. They're putting in boilers, they're putting in this, they're doing all this, that heavy lifting, heavy expensive type stuff. You're going to have to give a deposit so they can actually go to the store or go to their supplier and buy the stuff. And so, as a rule of thumb, you got to probably err on the higher side of what that deposit would look like. So let's say $40,000. Let's just be super simple. Let's say 25%. So that's $10,000. You got to have 10 grand available as part of the purchase of the, like when you buy the property around that same time, 10K to start the renovation. Because what you don't want to do is buy the property and then let it sit there and not do any renovation. You need to buy the property, and as soon as you close, begin doing demo, or at least planning what you're going to do with the property. If you don't know by now, maybe you're buying it really quick and you haven't had a chance to really plan out what the end result's going to be. So now you got to actually sit there and think about that and break it down. There's an element of, you know, getting obviously your plans in place, using an architect on certain projects. We have a number of those in Bergen County we're doing right now, where we have large renovations. We have architects, you know, paying thousands of dollars per project in some cases, because it's massive construction projects. You got permit packages, then you got the demo, of course, and you got the clean out in some cases where there's a lot of stuff left behind. So Rich just had one not that long ago. Him and Phil actually, I think, took care of a big clean out of a property up in Bergen County. So you'll be surprised sometimes you find some good stuff, you know. But at the end of the day, I hope I'm not going too long-winded with this, Rich. Is this helpful, you think? Do you think people are getting?
No, absolutely. No, it definitely is. And then, you know, let's, you know, talk about that. And then that kind of bridges into the second part of this whole thing, is once you have the hard money loan, what are the other costs, you know, as far as that you're going to have to come up with, which is called gap funding, and get into that portion.